And when you get up in the morning and you're having a look, what are the key signals you're looking for?
So I start always with prices. So what we're doing is looking at the way that interest rates or other asset classes move up and down through time. You're looking at prices, and I like the expression that technical analysis is horoscopes for men. I think that that's a funny way to describe it. But what I do is not technical analysis, meaning that I'm not looking at statistical patterns and trying to figure out the next trade. What I'm actually looking and I'm doing is what I call price study, which you're studying the time series of prices over a long time horizon. And through that picture, which is a chart, you don't even need any lines or indicators on it. All you need is the image. And with the image, you can see buyers and sellers are doing this. You can just see it. If a price is going up over a 10-year time horizon, what are buyers doing? They're overwhelming the sellers and vice versa. So when I look at prices in the morning, interest rates up, down, stocks up, down, I'm looking at it, of course, today, but then I'm zooming out to what has it done this week? What has it done this month? And what are the prices telling us about supply and demand in these specific markets? And through that, I extract information about the global economy, what's happening, the demand for liquidity, the demand for risk, and the demand for safety. All of these factors are in play at all moments when financial markets are open. So when I get up in the morning, I'm looking at prices. That's the first place I look to see, is there any immediate information that I can extract if something is up a lot or down a lot? Then I will go to the news and I will read maybe what caused some of those movements. And then I'll turn my attention to the economic data set. So that comes out, in the morning, in the first few hours in the morning. And I'm able to take each one of those data points and determine that this is important, this is not, filter it in, and then add it to the framework.
And how important is the actual rate itself versus the movement in rates?
It's a good question. The absolute level of rates is definitely important, right? Because if you think just from a basic corporate finance perspective, if you have $100 million note, it's floating rate. Your rate is 2% a few years ago. Your annual interest rate expense there is $2 million, right? So you know that on a monthly basis, you're going to need about $200,000 going towards this debt payment. And if you're bringing in $400,000 a month, you have a positive margin. But if rates go to 6% on that loan, now you have $6 million a year divided by 12, that's 500,000. So you have $500,000 in interest rate expense, but I just told you that your revenue was 400. So the level of rates does matter a lot. But, so does the direction and the movement itself. But when I think about today and interest rates being at 5 to 8% for basically most of the borrowing economy, right? The government's borrowing at about 4 to 5%. The private sector somewhere in 5 to 8% in the investment grade or the good credit realm. That's expensive relative to the last 15 years.
Relative to the last 15 years, but is it more healthy to have, I don't know how to put it, like a decent cost of capital? Because we know 0% interest rates have kind of like skewy effects. So is it more like it's a tough adjustment going up to these rates, but it's good? Because I remember as a kid, you used to get the TV adverts, Yorkshire Banks, savings account with us, 7-8% interest. And my dad knew if he wanted to borrow money, it was expensive. But if he wanted to save, there was a good incentive. There were good interest rates. We got to a place where I remember like Revolut. I was told my interest rate in my savings account was going up to 0.25%. Like absolute garbage. No incentive to save when the interest rate is so low and inflation is so high. So are we adjusting back to a more healthy place?
So instead of arguing healthy versus unhealthy in the absolute level of interest rates, think of it as a lagging indicator to current situations. So what's the current situation? High inflation relative to the last 40 years, right? So we're in a high inflation environment right now. And in a high inflation environment, those with capital are going to demand more money to deploy that capital in the form of higher interest rates. So it's actually a market lagging indicator to the current dynamics that we face in the global economy, which is predominantly inflation right now. And so instead of thinking that, yes, it's healthy, and I would argue that, yes, generally a 5% cost of capital is more healthy than zero, because a 0% cost of capital will give rise to silly and nonsensical investments, right? Because the annual interest expense is nil or effectively nil. So if you don't have any profit, there's no punishment for it, right? But now with interest rates at 5 to 8%, if you don't clear the profit, you're going to either be going bankrupt, you're not going to get your loan rolled, and you're not going to be, able to fund your projects which generate the cash flow in the first place. So yes, I would argue that 5% is better than zero in that it prevents some malinvestment. But it's actually just a function of higher inflation, that you have to demand more interest from borrowers if you are a lender. And in that way, you effectively are slowing down investment and increasing savings, or the propensity to save, with that type of activity.
Okay, so which parts of the economy are the interest rates set by the market, by the private sector, and which are set by the central banks? Because central banks set rates.
Yeah.
But what you've just said to me there is something that I've never even crossed my mind. It's like, yeah, if I'm going to deploy capital and inflation's at 8%, well, I kind of want 10%.
Right.
Yeah, it just hadn't crossed my mind that I as a deployer of capital would want to do that.
Yeah.
For me, I just always thought interest rates were set by the central bank,
Sure.
and everything rolled on from that.
So, maybe Danny can pull it up if he can find a chart from one of the recent Bitcoin layers. I can't, point to any one specifically, but if we've published charts, the 2-year yield, Treasury 2-year yield versus Fed funds, and we overlay them. And this is a chart we've been tracking basically since we started the Bitcoin layer in 2021. What we show you is that rates lead the Fed. The Fed is simply lagging. So when the Fed increases interest rates from 0 to 5%, if you look at it on a chart, it's simply 3 to 6 to 12 month lag of the 2-year Treasury yield that was sold, meaning the bonds were sold, yields went up, right? When bond prices go down, yields go up. So those that owned 2-year treasuries yielding 1% looked at either their grocery bill or the CPI data. Doesn't matter, right? You understand that it doesn't matter if they looked at CPI or they looked at their grocery bill or they looked at their rent. It was going up. So they said, I got this instrument paying me 1% is not going to cover my increase in prices for the next 2 years, because I see that as 5% in the market. So I'm going to sell this instrument. And the selling of each person, each investor that sells their 2-year note at 1%, then it goes to 1.5, then 2, then 2.5. Who is stepping in to buy the 2-year note at 2.5%, a year and a half ago? The answer is basically nobody, because the yield went to 5%. And when did the Fed get to 2.5% or 5%? If you look at the chart, it's months after the market had already gotten there. So yes, the central banks set their policy rate, but it is basically a lagging indicator to where the market puts them. And that is something that we can empirically prove, and we have with, the visuals of interest rates versus, market interest rates versus central bank policy rates.